Low-risk investments are necessary in every portfolio. Just like how soldiers need armor to protect themselves, you need low-risk investments to defend you from volatility. Think about it, why would soldiers wear heavy armor when they could bring so many more guns and ammunition instead? They understand one concept. Having all offense is nice until you have to take a hit. While there are many approaches to investing, the best investors in the world all share one common strategy. They know how to strategize and protect their downside. In fact, Warren Buffett frequently highlights his top two rules of investing. Rule 1, don't lose money. Rule 2, see Rule 1. Why the emphasis on not losing money? When you lose 50% on an investment, you need a full 100% gain to break even. During the 2008 financial crisis, Kyle Bass turned $30 million into $2 billion in 2 years. To make a return that big, people would think that he took massive risk. However, he actually only risked 3 cents for every dollar he made. If you want to apply this idea and protect yourself, you can. If you want to invest in the stock market but don't want the market swings that come with it, you have a few options. Most people don't even know these exist. After the 2008 crash, many people were afraid to buy stocks, so they looked to products that gave upside without the downside. If the market goes up, you make money, but if it goes down, you don't lose. Depending on your goals, these may be good for a portion of your investment portfolio. However, since there are variations for each of these, you must review the terms and conditions carefully or have a fiduciary explain them to you. The first one we have are structured notes. Structured notes are like loans to the bank or some other organization. These loans have special features and there are many different kinds of them. The terms of the note will generally outline 1. How much you will make, for example, the returns linked to the performance of an index, and 2. When you will get the money, for example, quarterly or all at the end. The best ones are those that are linked to a stock market index, for example, the S&P 500, and give 100% principal protection, meaning you won't lose what you put in. What's the catch here? You give up part of your gains. Let's say you have a 3-year note that is based on the S&P 500. Here are some of the conditions it could have. 1. Get part of the upside with principal protection. If it goes up, you keep 80% of the gains, but if it goes down, you don't lose a dime. 2. Higher risk for higher reward. If it goes up 10%, you get to keep 1.2 times the return, but if it goes down more than 30%, you take the full loss. Lastly, you need to be aware of 3 risks. 1. Liquidity risk. They can't be easily converted into cash. 2. The default risk. If the bank that gives you the note goes bankrupt, you could get nothing back. 3. Timing risk. If you bought a 5-year note and the market was up the first 4 years but collapses in the 5th year, you lose your gains. If you're enjoying this video so far, make sure to hit that like button and subscribe button for more videos like this. Number 2, we have a market link CD. A market link CD is basically a loan to the bank. How much you earn in interest will be based on the return of something like the S&P 500. If the market drops, you won't lose money on your initial investment. Additionally, if the bank collapses, the FDIC will step in and pay you back up to $250,000. Some market link CDs will even offer you a fixed interest rate as well. So what's the catch to this amazing opportunity? Even though your initial investment is protected, your gains will be limited. There are 2 things you need to be aware of: interest cap and participation rate. Interest cap limits the maximum return you can get. If the cap is 10% and the S&P goes up 20%, you will only get 10%. Participation rate determines what percentage of the gains you get to keep. If the rate is 90% and the S&P goes up 10%, then you only get to keep 9%. Like regular CDs, market link CDs have a liquidity risk. If you withdraw your money early, you must pay a penalty. Market link CDs also have a call risk. The bank can buy back the CD before the end of the date, so you will get a lower than expected payout. The last one we have is a fixed index annuity. It's a contract between you and an insurance company. For every dollar you deposit, the insurance company will give you a certain amount of monthly payment when you retire. How much you get will depend on how well the index performs, like the S&P 500. Fortunately, even if the S&P drops, you won't lose the money you put in. However, if the insurance company goes bankrupt, you won't get your payments. So you must pick a strong one. Like market link CDs, there can be an interest cap and or a participation rate. You must also be wary of any other annual fees which take away from your yearly gains. Now, just because 2 supermarkets both sell apples does not mean they sell the same quality of apples. The same applies to all these investments. You must read the terms and conditions and understand what you're investing in. Not all versions of these products are great. Some have high fees, commissions, penalties, or hidden charges. If you want more low-risk investments, this next video will cover 11 more safe investments to grow your money. Regardless of which one you pick, do not stuff your cash under your mattress because you are literally losing out on free money.